Hi friends, welcome to the channel JIB and CIB Made Simple. So in this particular video, we are going to discuss quickly revise our IIBF CCP Certified Credit Professional Module A. Module A is based on introduction and overview of the credit. So let's get started with our first point, that have you ever wondered how bank protect your money when they lend it out? Let's break down the 5 golden rule that bank follow to stay safe and to stay profitable. So the first thing is that safety first. So bank don't take risk with your deposit, right? So the rule number 1 is the safety. So what does it safety ensure? So safety ensure that since they are using customer money, they only lend to borrow who are likely to pay it back. Second point is the diversification. So diversification means lower risk. To avoid putting all egg in one basket, what bank do? Bank spread loan across different industries, different region and different collateral type. If one borrower fail, the other balances the loss. So that is the second point, that is called diversification. The third point is stability with the government bond. Bank love government bond. They are stable, they are liquid, they love low risk, right? So during crisis, what happen? These kinds of government bond acts as a financial safety net, ensuring that bank don't run out of cash. Next point we have is the predictability, which means that basically predictable returns. Unlike a stock, government security have steady interest rate, making them a reliable income source. This help bank stay profitable without wild fluctuation. So the next time you deposit money, know that bank follow a strict rule. So we have discussed the 4 rule, right? Safety, diversification, stability and predictable return. So I hope this concept is clear. Now friends, let's look at the next slide. So friends, did you know that RBI has a strict rule to protect borrower like you? From loan transparency to fair treatment, here is how bank must behave. First of all, the first key point is RBI's loan restriction. So RBI can ban loan against essential good like food, grain and cotton. Why? Why RBI can ban loan against these kinds of essential good? Because to prevent speculation and to keep price stable for everyone. So that is called RBI loan restriction. Right. So why RBI restrict the loan against this essential good? To prevent speculation and to keep price stable for everyone. Now, second point is loan are not just about collateral. You know it very well that bank now check loan purpose and national interest, not just your security. So liberalization forced them to adapt, making credit smarter and making credit fair. So loan are not just about collateral. Next point is the Fair Lending Practice Code, which we call FLPC. For loan under 2 lakh, FLPC ensure no hidden charge, clear timeline, courteous services. Bank must disclose rate, terms and fees upfront. That is called Fair Lending Practice Code, which was implemented from 1st January 2003. Now friends, the next point is the borrower right. What is the so specific about borrower right? You have the right to a written acknowledgement, that is called token of services. So you can see that you have the right for a written acknowledgement and a processing timeline. Sanctioned loan need your signed acceptance, no surprise. So that is called all standard terms. It must be provided to the loan applicant within the application form, right? So branch should display current interest rate and service charge. One more thing I told you, that branch must issue an acknowledgement, that is called token of services. That is a written acknowledgement and a processing timeline. Then I told you that one more important point is that for priority sector loan up to 2 lakh, this acknowledgement should specify the expected processing time frame. So time frame should also be specified. And one more thing is that once a loan is sanctioned, so it very well that once a loan is sanctioned, what happened? The borrower acceptance of the terms and condition must be formally recorded with their signature on the sanction document. So that is the point, that sanction loan need your signed acceptance, means no surprise. So friends, the point is that knowledge is power. Now you know how RBI safeguards the borrower, right? I hope you agree with this. Now friends, let's switch our focus to the next slide that we have. Why do bank reject loan? What is this base rate? Don't worry, I will explain banking rule in the simple term. First of all, your loan right. Bank must send you regular statement unless you say no. If they reject your loan, they must tell you why. There should be no secret. Second point is FLPC. I told you about this Fair Lending Practice Code. It ensures that customer grievances are addressed within the defined time frame. Next point is, the base rate rule. So, forget BPLR, right? You forget BPLR. Now bank use base rate to decide the loan interest rate. You must know that no bank can charge below this base rate unless RBI allow it. And one more point is regarding the staff loan, right? So BPLR, benchmark prime lending rate, it has been replaced by the base rate system. And one more point is that, a staff loan is not a special treatment. Means even bank staff play normal rate on most loan. Only a special staff benefit get discount. Rest pay like everyone else. Then one more point is that late payment will cause penalty. If you miss a payment, bank charges extra interest. That is called, penal interest. It apply for delays or breaking loan rules. Then one more point is, fixed versus changing rate. What is the meaning of this fixed versus changing rate? See, fixed rate means same interest rate forever. Floating interest rate means, it changes if RBI or base rate change, right? So you should pick what suits you. So now you are a loan pro, right? These are the important points which you must keep in the mind. So remember, if the interest rate remain unchanged throughout the loan period, regardless of the fluctuation in the base rate, it is called fixed rate. And obviously the opposite of the fixed rate is the floating rate, floating interest rate. So the next point we have fixed or floating rate. Bank rate versus call rate. Confused? Let's break down loan interest rate in just few minutes. But bank can still change it if RBI allow or if they warn you in advance. Now what about the variable rate loan? See, floating rate loan are called variable rate loan. In this case, what happens that EMI changes when RBI or bank rate change. It is good if the rate drop. It is risky if the rate rises. So that is called, variable interest rate, because the name itself suggests that, interest rate can vary after loan disbursement. It's called variable interest rate. Now the question is, who gets cheaper loan? So big businesses, high tech company, they often get discount. So what happen, bank check their value, credit score, and how profitable they are. So borrower with large or technologically advanced facility, they may receive preferential rate based on account rating, business value, servicing cost, and internal criteria. Now let's compare bank rate and call rate. So basically, bank rate is the RBI loan rate to the bank. So it is the rate at which RBI lend to the bank or RBI buy certain commercial paper. So remember this section 49 of the RBI Act, right? So what happened in the bank rate? The bank rate is the rate as which, RBI give loan to the banks, right? RBI lend to the bank or RBI buy certain commercial paper under section 49 of the RBI Act. Remember it. Then what is the call rate? So call money rate is the rate at what bank charges each other for overnight loan. So suppose two banks are there and they are mutually lending between each other. So obviously they will charge the interest. So whatever bank charge each other for overnight loan is called call rate, right? And usually it is very short term loan between the banks and obviously overnight. Both bank rate and call rate affect your loan rate. One more point is that remember, since April 1st 2002, bank calculate loan interest on a monthly basis as per the RBI instruction, right? So this is a very important point. What about the late bill payment? If you pay a bill after a due date, bank charge extra interest monthly, so avoid delays, right? So interest must be recovered at time of purchase or discounting the bill for relevant period. And when a bank purchase or discount inland or foreign bill, both standard charge and upfront interest are collected. And I told you, if a bill is settled after the due date, additional interest for the delay is charged at a penal rate. So these are the important points which we have covered in this particular slide. Friends, if you are looking for any study material for CCP in the form of PDF, in the form of previous year questions, so you can enroll in our CCP course which is available on our app JIB and CIB Made Simple. The link of the course is provided in the description section, or you can WhatsApp me on this particular number to get more detail. Now friends, let's look at the next point that we have. So the next point, did you know that bank can't lend to their own director? Or bank cannot charge interest unfairly? Let's uncover 5 banking rules that you must know. First of all, farm loan work differently. Farm loan follow seasonal interest rule. So what is the seasonal interest rule? Not monthly, rather the farm loan follow the seasonal interest rule. RBI, NABARD decide when interest is charged, helping farmer match the crop cycle. So RBI or NABARD decide, when interest is charged, and it basically help the farmer matching the crop cycle. One more point is that bank can't play favorite. Bank can't lend against their own share, or bank can't lend against their own share, or bank cannot give loan to the director, right? So they cannot lend against loan which is secured by their own share. as per section 20 subsection 1 of the Banking Regulation Act. And also, lending against the share of the bank on subsidiary is not permissible. Means, they cannot lend against their own share, or they cannot give loan to the director unless it is secured by FD. Remember, so they cannot extend credit to the director or to entities. So unless it is secured by the direct FD, insurance or government bond. Very, very important point. Bank cannot extend credit to the director or to entity in which director have a significant interest, right? And these restrictions do not apply to loan provided to director. So suppose some loan is given to the director, and when such loan is basically secured by government security, LC policy, fixed deposit, in that case bank can lend, but in all the situations they cannot do. Now one more thing is that no BIP treatment, which means even CEO, even director need RBI approval for personal loan. Right, very, very important point. So suppose the CEO need personal loan, so loan can be given in the form of personal loan, but before that they need RBI approval. Normal rule apply, no special discount. Now one more thing is a zero discrimination, which means bank must treat all borrower equally. No bias based on caste, gender, religion. So your loan depends on merit and not the background. So that is called non-discrimination. Then we have the next point, that no bullying for repayment. So it means that bank can't harass you for repayment. No call at odd hour or no threat. Only fair human recovery methods are allowed. So that is the point, that no borrower should be harassed. No borrower should be contacted at inappropriate hour or subjected to coercive method for loan recovery. So these are the important points which we have just covered. Now friends, let's switch our focus to the next slide. Did you know that bank can't give loan to kids or people with certain legal issue? Let's break down who can and who can't get a loan. So the first point is who can get a loan. You know it very well that banks lend to adult. Adult means 18 plus only, as per the Indian Majority Act. So who are the minors? Minors are those people who are under 18 as per the Indian Majority Act, right? Or under 20. So bank lend to adult only. Minor can't sign contract, so no loan even with the parents' help. So that is a very important point. Minors are not legally eligible to enter into contract. Next point is guardian matter. So if a minor has no parent, court appoint guardian, but even then also no loan till they turn 18. So that is what I am telling you, that individual who are mentally incapacitated or legally disqualified, he cannot engage in loan agreement. And legally, if anyone 18 is considered as minor and he lacks the capacity to contract, so this is the point. And I told you very well that adulthood is reached as age of 18. So whether guardian is natural or court appointed does not matter. Guardian of minor comes in 3 types. So what are the 3 types? One more thing I want to talk to you, that if someone can't make legal decision due to illness, due to disability, so bank can't give them loan. It is a law, right? And 3 types of guardian I told you: natural guardian, which is typically the parents; testimonial guardian, which is appointed by will; and legal guardian, who is appointed by the court. So 3 kinds of guardians are there: natural, testimonial, testamentary and legal. So one point you must note that basically a testamentary guardian steps in only when both natural guardian are deceased. Yes, so both natural guardian means fathers and mother. If both are deceased, then only testamentary guardian comes into picture. Now court will assign a legal guardian when neither a natural nor a testamentary guardian exists. A natural guardian ceases to be one if they renounce Hinduism or become a sannyasi. Right. So let's look at some more points what we are talking about. These are the very, very important aspect. So question is, can kids take loan, sign check, become business partner? The answer will surprise you. See, first of all, no loan under 18. With court guardian it is 21, and minor can't sign binding contract ever. Remember, this is a very important point. According to the section 3 of the Indian Majority Act, anyone under 18 is minor unless a court appointed guardian is involved. I told you there are 3 kinds of guardian. The first type of guardian is called natural guardian, which is by nature. Second kind of guardian, testamentary. If both the natural guardian are deceased, then comes the role of the testamentary guardian. And if suppose natural guardian is also deceased, testamentary guardian is also deceased, then in that case court approved guardian comes to play. And the rule says that basically if the court appointed guardian is involved, legal adulthood is reached as 21. Very, very important. So with court guardian, the legal adulthood is not 18. Legal adulthood is age 21. Remember it. And one more point is that minor cannot appoint agent or delegate authority to other as per section 183. So they cannot delegate authority to other. And also they cannot sign the binding contract ever. Very, very important point. right? Minor may be made an agent. Only the principal is bound by this action, not the minor. Suppose you made a minor agent of, so in that case minor is not liable for any activity, rather principal will be the liable. You know it very well. Now one more point is that signing the check, very the adult co-signer pay if it bounce. So remember, minor can sign or endorse check and bill, but bear no legal liability for them. Responsibility rests with the other party, and they are not allowed to nomination. Yes, this is a very important part. Remember, minors are not allowed to nominate someone. If a deposit is in minor's name, only an authorized person can make a nomination. Conversely, a minor may be nominated. Yes, he can be nominated. Minor cannot be a partner in a firm. Very important. Kids cannot be business partner, but can get profit share. Yes, they may receive benefit from the partnership arrangement. One more point is that upon turning 18 or 21, if it is court guardian, I told you na, if it is a natural guardian or if it is testamentary guardian, it is just 18. Then in the case of court guardian, it is just 21. So at 18/21, they get 6 months to opt in or walk away. Right. So minor must decide within 6 months whether to continue as a partner. Failing to respond with, he can walk away. Now, a minor has no authority to stop payment of a check issued by a partnership. Very important. Suppose a partnership firm has issued a check. Minor has no authority to stop payment. Once majority is attained, check signed by the former guardian should not be honored, even if the dated prior to the adulthood. Very important. Name changes involve minor. Yes, very important thing when talking about that, guardian power. What is the power of guardian? So the power of guardian is, father is the primary guardian, mother is the backup. But guardian lose control the day the kids turn adult. This is a very important part, right? So according to the section 6 of the Hindu Minority and Guardianship Act, a Hindu boy or unmarried girl, father is the primary natural guardian, followed by the mother. Now that is the point. Now another rule says that, did you know that a 16-year-old bride husband become a legal guardian? How guardianship really work in India? Let's have a look. So as per the Hindu law says that if the minor girl is married, husband become guardian. If she become widowed, father-in-law takes over. But if dad become a monk, she loses the right. So that is the point. For a married Hindu minor girl, her husband is recognized as a natural guardian. If her husband is a minor or if she is widowed, guardianship passes first to her father-in-law, then to her mother-in-law, despite them being not the natural guardian. And if a Hindu minor guardian renounces Hinduism or become a hermit or sannyasi, then that person loses the natural guardian status. This is the very important thing. Now in terms of Muslim law, what does Muslim law say? That father is a primary natural guardian, grandfather is a backup, mother only if named in a will. So remember, in the case of Muslim law, father is the primary natural guardian. Muslim father may appoint a testamentary guardian through a will, and mother may also serve as a testamentary guardian. Now one more point is that if the Muslim father dies without a will, guardianship is assigned to the paternal grandfather. Now one more point is that following the death of the paternal grandfather, any guardian named by him will assume responsibility. If no testamentary guardian will be appointed, the court will assign one. Then the court will come. And one more point is that, among Shia, Sunni tradition, only the father is recognized as the natural guardian. The mother role as a guardian is not acknowledged even after the father's death. Now what about the Christian, Parsis and Jews? Remember, father is the automatic guardian. Mother needs court order except for married daughter. So there is no specific statute appointing them as the mother as the minor guardian. Rather, father acts the guardian by default unless it concerns a married daughter where the husband may act like a guardian. Now one more point is that, for Hindu minor, even if the father is alive, the mother is permitted to open and manage any deposit account in the minor's name. Right? Remember, very important point. Suppose a Hindu minor is there, right? And even if the father is alive, mother is permitted to open and manage any deposit account in the minor's name. Now there is a very important aspect we are going to discuss now. Question is, can a 10-year-old open a bank account? Can mom control kids' money? So banking secret that no one tells you. Let's understand. First of all, minor power. So kid who are age 10 plus, right? They can open and operate account if they can read, if they can write. This is a very important thing. So if they can read, if they can write, those minor, they can operate account and open account also. Two siblings can even share a joint account also. This is the power of minor, right? What is the mom's right? I told you that Hindu mom can manage account freely. What about other? So only court approved guardian, but they can't loan or be declared bankrupt ever. So this is a very important point, that any joint account holder can stop check payment, but all must jointly revoke the stop payment instruction. Yes, check payment can be stopped. but they must jointly revoke the stop payment instruction. And operation condition must maintain. This is a very important aspect, right? So what I'm talking about, did you know that a 10-year-old can have a bank account, or that partner can be personally liable for firm debt? So let's look at it. First of all, let's talk about the joint account. I told you that in joint account, if one holder dies, money goes to the survivor. You can see clearly written here, right? So suppose in joint account two person are there. If one person dies, if one holder dies, so to whom the money goes to? Money goes to the survivor. And when all the joint holder passes away, nominee or legal heir inherit. So remember, always set a nominee. That is the point. So the bank pay the surviving account holder, right? And legal heir if one or more account holder pass away. This is the point. Now one more point is that what is the survivorship rule in the case of joint account? In joint account, I told you the money goes to the survivor if one holder die, right? And when all passes away, nominee or legal heir inherit. Now let's simplify the account operation. First of all, joint account can work in three ways. The first way is anyone can operate, right? So you can see joint account can operate in anyone can operate. Second is almost signed together, and third one is only the first name person will sign. As you can see, three operation written here. Operation severely means anyone can operate. Then operation jointly means almost signed together, and third one is only the first name person operate. So these are the three way joint account can work. Now you must know that repayment option for term deposit include repayment mode. Okay, these are not that one important. Yes, this is a very important aspect. Remember, as per the Companies Act 2013, a firm can now have 100 partner, but minor, NRI, mentally ill can't join it. What is the biggest risk is that each partner is personally liable for all the debts. So we are talking in the context of partnership firm. You must know that in the context of partnership firm, a firm can have 100 partner, but who are not included? Certain entities like NBFC, HUF, minor, insolvent, mentally unsound person, they cannot be the partner, and each partner will act like an agent for the firm and other partner. Remember it, very very important. Now one more thing is that what happened after death and banking? See, whenever a partner dies, the firm dissolve, but survivor can still operate the account. For joint account, check stop if the first holder pass away. So suppose a partner dies, what will happen? Then the firm will get dissolved. However, the survivor can still operate account. Right, so that is the point. Now one more point is that suppose a partner died and the partnership account is overdrawn. So what does it say? Let's have a look. Suppose one partner dies, can the other partner still use the account? The answer could save your business. Let's look at it. See what happened if a partner die with an overdraft or overdrawn account. So you should freeze the transaction immediately. You should determine the disease share, else surviving partner pay all the debt. That is the point. Suppose a partner die and the partnership account is overdrawn. So account operation must be halted. Account operation must be ceased. Right. You should determine the liabilities of the deceased, retired, insolvent partner. Otherwise, the Clayton's rule will apply. Right. So freeze the transaction immediately, determine the deceased person's share, and else surviving partner pay all the debt. Now what is the registration rule? Suppose the firm is unregistered. So you cannot sue the debtor, but they can sue you. So always register your partnership firm. See, it is not mandatory to register the partnership firm. So if the partnership firm is registered, what happened? So a registered partnership firm can sue you to enforce contractual right. Any partner, including a sleeping partner, can stop check payment issued by the other. Right. So any partner can stop payment, even silent partner also. But reversing it, it needs everyone approval. Now who can join? So remember, partner cannot delegate their authority to outsider without written consent. And Indian Partnership Act 1932 governs all the partnership agreement. One more point is that when transacting with a partnership firm, lender must confirm the firm registration status. This is a very very important aspect which we are talking about, right? So let me explain one more thing is that 2 to 20 partner can be maximum. You can see a partnership must have at least 2 partner. The maximum is 10 for banking and 20 for other firms. No minor, no insolvent is allowed. And one more point is that all partner liable for every rupee. Very very important aspect. Now let's talk about HUF. So the question is, HUF can't partner, trust can't join firm. 90% don't know this partnership rule. Let's see. First of all, let's talk about the traditional partnership. Remember, HUF, that is Hindu Undivided family, cannot enter a partnership because they lack joint accountability for other member action. Then trust. What about trust? Trusts are also ineligible for partnership firm. Why? Because partnership are intended for business, not for trust. One more point is that registration is handled. Partnership registration is handled by the registrar of the business. Suppose you want to register a partnership. So registering a partnership firm is optional. However, one more is, this is a very important point. What is the point? That unregistered firm cannot sue for recovery of debt. Yes, it is. I told you earlier that registration of the partnership is optional. You need not, it's not mandatory. But if it is unregistered, what will happen? That if the firm is unregistered, it cannot sue for recovery of debt, while others retain the right to sue them. And every partner carry unlimited, both joint and individual. So every partner carry unlimited liability for the firm action during their tenure. And suppose the partner become insolvent, very, very important, right? So if the partner become insolvent and the account is in credit, the remaining partner may continue operation only with a new banking mandate, and they should pay on old check issued by the insolvent partner, require their confirmation. So what I'm talking about, traditional partnership is easy to form. They don't have unlimited liability, right? So that is the point which I've just discussed. So, all partner can operate the partnership account, and any operational change need unanimous consent. And partner cannot delegate their operational authority to the other. These are the super important point which we are talking about. Now friends, let's shift our focus to LLP. So what is LLP? Limited liability partnership. So it blend element of partnership and limited liability company into a single corporate entity. So friends, if we talk in the terms of LLP, which is limited liability partnership, so remember, liability is your investment only. You can have unlimited partner. Very, very important thing. Try to understand. A traditional partnership cannot have unlimited liability, but this LLP here as the name suggests, limited liability partnership. So there are two elements: element of partnership and limited liability company into a single corporate entity. So it is a distinct legal body. Is it a distinct legal body? It is separate from its partner, and it must include the limited liability partnership or LLP in its name. LLP is liable up to the full value of its asset, while each partner liability is limited to their agreed upon contribution. Yes. Whenever LLP is formed, every partner agree upon their contribution, and they are only liable up to that, not more than that. One more point is that LLP require at least two partners. Very, very important. That LLP require at least two partners with no maximum cap on partnership size. Which means limited liability partnership require at least two partners, and there is no maximum cap on partnership size. And a body corporate including an LLP can itself become a partner in another LLP. So LLP can become partner in another LLP. This is allowed. One LLP is there, it can partner with another LLP. Now one more important point, very, very important aspect talking about. So your LLP can live forever even if the partner quit. That is why smart entrepreneur choose LLP. This is the very important aspect talking about. What I'm telling you, that your LLP, it can live forever even if a partner quit. While in the case of partnership firm, what we recall, if any partner quit, the firm must be dissolved, right? So this is a special criteria. So let's talk about the LLP superpower. So I told you that change in the LLP partner do not impact the LLP existence, right or liability. Partnership firm, private limited company, unlisted public company, they can be converted into LLP. However, LLP cannot be converted back into company or partnership firm. So vice versa, very, very important thing. So LLP superpower is that it never dies. Partner can come, partner can go, LLP will continue. Second superpower is that no asset registration. Unlike company, in the company you need to register your asset, while in the case of LLP you require no kind of asset registration. The third superpower of LLP is that it is easy decision. No board meeting is required. Let's talk about it in the detail. HUF and minor are not permitted to partner in LLP. In the case of partnership, what we talk about, a minor can be a partner, but he will have no liability. However, here in the case of LLP, what I'm talking about, that he cannot be HUF and minor, they are not permitted to partner in LLP. And LLP must be registered with the ROC. What is ROC? ROC stands for Registrar of the Company. So remember, LLP must be registered with the ROC. LLP can open current account and term deposit in their name. And one important aspect talking about, that the LLP agreement. So this agreement is signed by all the partner. It must be provided. So LLP agreement must be provided. If none agreement is exist, so a Schedule 1 of the LLP Act signed by all the partner will apply. So remember, LLP agreement must be provided. If none agreement exists, a Schedule 1 of the LLP Act signed by all the partner will apply. One more point is that designated partner are the authorized signatory for the LLP. So friends, the next point is that the LLP is liable up to the full value of the asset, while each partner liability, I told you it very well, right? And one more point, I told you that LLP must be registered with the ROC. They can only open current account and term deposit in their name. Designated partner are the authorized signatory for the LLP. KYC compliance is mandatory for every LLP partner. No formal resolution is needed for routine LLP decision as per the LLP Act. And there is no provision for registering charges on asset of LLP with the ROC. So you need not register charges on asset of LLP with the ROC. And suppose LLP has more than two partner, they must maintain continuous existence regardless of the partner changes. Suppose partner got changed, right? So LLP who have more than two partner, they must maintain continuous existence. Now let's talk about the HUF. So friends, did you know that a woman can now become a Karta of HUF? And here is how Hindu family business really work. Let's look at it. So how HUF is formed, HUF are formed by individuals from Hindu, Sikh, Jain community and center around a shared ancestor and their descendant, now including female since September 2005. Joint owner in HUF, they are known as co-partner. Yes, joint owner in HUF are called co-partner, and HUF consists of one common living ancestor and up to 3 generations of male or female descendant. The elder co-partner include female, act as the Karta of the HUF. Yeah, very, very important. Females are also included in that. So Karta is the boss. Even if living abroad, he is the boss. All major male and female member are co-partner. Right. So the eldest co-partner act like a Karta of the HUF. Now one more point is that the senior most co-partner remain Karta regardless of the residence. Even if outside India, right? If he is outside India, he remain Karta. No matter he inside India or outside India, and he can delegate management to another co-partner or third party. So remember the senior most co-partner. So who are the co-partner? Remember the word co-partner, joint owner in HUF, they are called co-partner. And HUF consists of one common living ancestor and up to 3 generations of male or female descendant. The senior most co-partner remain Karta regardless of the residence, even if outside India, and can delegate management to another co-partner or third party. Remember, only those authorized to operate the HUF account can stop check payment. Co-partner without permission cannot. Remember, very, very important aspect we are talking about. Only those authorized to operate the HUF account. Some people are authorized to operate the HUF account. Only those people can stop check payment. Co-partner without permission cannot stop the check payment. Right? Some person who are authorized to operate the HUF account, they can only stop check payment. Karta holds sole authority to incur debt for family business and legal necessity. So only Karta can take loan for the family. That is what I mean to say. And members' liability is to only their share. Like in the case of LLP, we have discussed that member liability only to their share. Similarly here also, right? And if we talk about some shocking HUF fact, see, HUF can't form partnership. Since HUF is not a legal person, so it cannot enter into a formal partnership agreement. Second point is that new babies, they become automatically member. So Karta bear personal liability while co-partner liability are limited to their respective share. Remember, this is a very important aspect. Private limited company must know that minimum 2%, maximum 200 member are allowed. Public subscription to capital is prohibited, means no public fundraising is allowed in the case of private company. And one more point is that minimum 2 director is there, maximum no limit, and minimum paid up capital is 1 lakh. These are the very, very important aspect about private limited company must remember. So okay, tell me, what are the limits of the member? Minimum 2, maximum 200. Is public fundraising allowed? No. Minimum how many director? 2 minimum director. Maximum limit? Nothing there. What is the minimum paid up capital? 1 lakh minimum paid up capital. Right. One more point is that Karta signature, all other stopping check, only authorized member can stop a check. Now friends, let's talk about the public limited company. So friends, one director company, 7 member rule, 90% entrepreneur don't know this company law. So if we talk about the public limited company, you must know that minimum 3 directors would be there and maximum 15 can be there without approval. So in the context of public limited company, it must have minimum 3 director, maximum no limit is there, and if the director exceeds 15, central government approval is required. Very, very important aspect, right? So minimum 3 director, maximum 15 without approval, and 7 plus shareholder, right? 7 plus shareholder. Such company require a minimum of 7 member with no upper limit. 7 plus shareholder are there, and 5 lakh is the minimum capital required for this public limited company. This is a very important aspect we are talking about. For public limited company, remember 3 things. First point, minimum 3 director, maximum 15 director without approval. 7 plus shareholder, 5 lakh minimum capital. So these are the important aspect about public limited company. Now one more thing is the OPC secret. What is OPC? You know, one person company. So as the name suggests, only one person is required, right? Only one person is required. Then one more point is that single director, he has the full control, and it is perfect for, you know, solo entrepreneur. You know, there are something called solo entrepreneur. So this OPC is perfect for solo entrepreneur. So it permits only one director. The registrar of the company issues the certificate of incorporation, and this certificate of incorporation, you know, it serves as the company birth certificate. You know, the certificate of commencement of the business is issued once the minimum public capital subscription is confirmed. See, OPC is formed, capital subscription is confirmed. Once the minimum capital subscription is confirmed, now, you know, the certificate of commencement is issued. Now friends, let's talk about the MOA. What is MOA? Memorandum of Association. It is a company constitution defining its relationship with the external world and limiting its power. And you know it very well. So you can call MOA as the company's constitution in single word. Amendment. Suppose you want to amend MOA. You can do that. Can you amend the MOA? See, you can amend the MOA, but for that, you know, you require a special resolution with 3/4 majority and central government approval. Very, very lengthy process. You can see, first of all, you need central government approval. Also, you require 3/4 majority, right? If they pass, then only you can amend MOA. That's why MOA is called constitution. So if you violate MOA, it is called ultra vires. It means beyond company power. Director, not the company, are held responsible. And now let's talk about the AOA. What is AOA? AOA is called Article of Association. You know, what is AOA? So AOA is like, you know, internal rule book, right? It comprises the company internal rule and bylaws governing management. So AOA details director borrowing power and processes for appointment, removal, retirement and rotation, right? So AOA act like an internal rule book. Suppose you break MOA. So if you break MOA, it is the director personal risk. At the director personal risk, you can break MOA. So what we have talked about, you know, Article of Association, it can be amended. I told you now, for amendment of MOA, you require 3/4 majority as well as you require government approval. Now what about AOA? Suppose we want to amend AOA. Can we do that? See, AOA can be amended by a general body resolution. Even if borrowing power are not mentioned, trading company possesses implied authority to borrow. So breaking MOA is at the director personal risk. So changing MOA needs 50 to 75% vote and government nod. And AOA is much easier to amend. As you can see, it can be amended by the general body resolution, right? Now the question is, what suits your business? You can comment. Now one more point is that, you know, regarding AOA, your company can borrow beyond its capital, but 90% director don't know this loan rule. Let's look at it. First of all, let's talk about the borrowing power. Okay, so before that, let me talk about, you know, private limited company have, yes, remember, private limited company, they can take unlimited loan. Public limited company, they can, their loan taking limit is limited to, you know, capital plus reserve limit. So what I'm talking about, you know, if it is a private limited company, they have unlimited borrowing power. If it is a public limited company, they may borrow up to the sum of their paid up capital and free reserve. Let's take an example. Suppose there is a firm whose paid up capital is 100 crore, whose free reserve is 50 crore. So can you tell me what is the maximum borrowing power? It is nothing but 100 plus 50 is 150 crore, not more than that. If you want to borrow beyond this, it requires shareholder approval in a general meeting. So let me summarize what we have talked about just now. If it is a private limited company, you can take unlimited loan. If it is a public limited company, your loan limitation is limited to capital plus paid reserve plus, you know, free reserves. And if you want to exceed this limit, shareholder vote is required. Now let's talk about the death of the director. So if the director death, no problem. Account keeps running, no delegation allowed, common seal not mandatory. Remember, the death of the director do not affect. So we are talking about into the context of company operation. Remember it. Right now we are talking in the context of company. Suppose the director dies, what will happen? So the death of director does not affect the company account operation. Means the account will keep continue as it is. First point. Second point is that company director cannot delegate their authority to others. So no delegation is required. Third point is that common seal not mandatory. So using a common seal on account opening form is no longer mandatory. Now, one more point is that if the company MOA or if the company OA, it is specify that you have to use a common seal, so its inclusion is voluntarily. Bank cannot require it for opening account. What I'm telling you, suppose a company MOA, suppose a company OA, clearly written in the company MOA and AOA that you have to use a common seal. So its inclusion is voluntary. Bank cannot require it for opening account. It is voluntary. It is not mandatory, right? Now friends, let's talk about the charge registration. So you must know these rules so far as charge registration is concerned. So I told you now, mortgage, goodwill, they have to be registered in 30 days. So remember, registration of charge is mandatory for hypothecation of stock, book debt, mortgage of property, SIP, goodwill or uncalled share. They are mandatory for these kinds of activity. Remember one thing, that registration of charge is not required for pledges of goods, securities, loan against fixed deposit. Remember, where charge registration is required? In the case of hypothecation, in the case of book debt, in the case of mortgage, in the case of SIPs. Where registration is not required? For pledges of good, securities or loan against fixed deposit. So remember, mortgage, goodwill have to be registered in 30 days. Then remember days also. As per the section number 125 of the Companies Act, it says that most company asset charge must be registered with the registrar within 30 days. So mortgage and goodwill must be registered within 30 days. One more point is that if it is pledge, if it is fixed deposit, then no registration is required, right? So remember, if it is pledge and if it is FD, in that case, no registration is required. And one more point is that, registrar may grant a 30-day extension for charge registration, for which additional fee up to 10 times the specified amount may apply. Yes. Suppose what are you talking about? Suppose I am unable to do the charge registration in the 30 days. So what will happen? So I will approach registrar. So registrar may grant 30-day extension. So he may say, okay, I am providing you 30-day extra. But you have to give me fee. How much fee? Fee can range up to 10 times the amount. This is a huge fee, right? So and suppose I need more extension. So extension beyond this, for that require company law board consent. I hope that makes sense. So what we learned is that AOE can be changed easily. MOE changes need 75% approval plus government nod. So friends, now let's switch our focus to the next point that we have to discuss. Did you know that a director can only hold 15 position? And second point, did you know that loan security can vanish if this 30-day rule is missed? Let's talk about it. So first of all, maximum 15 directorship per person. What I mean to say is that, any individual cannot simultaneously hold more than 15 directorship as per the section 275 of the Companies Act. Suppose I am there, I cannot be the director of more than 15 companies. That is the point. Second point is that charge registration deadline. I told you already, if you want to register a charge, it is primarily the company responsibility. You have to register the charge, right? If it failed, the creditor may do so instead, right? And what is the timeline? 30 days. Remember it. Now, priority always matter. What is the meaning of priority always matter? Suppose you fail to register the charge. Suppose you fail to file the charge. So obviously the loan will become unsecured and obviously immediately due. When charges are created in the favor of multiple banks, priority is given based on the date of the charge creation. See, suppose, try to understand. A particular company has taken loan from multiple banks and obviously all the bank will create the charge. Now, how to decide the priority in such case? So for that, there is a special rule. What I'm talking about, suppose company A, company B, company C, company D, suppose company A, they have taken loan from bank A, bank B, bank C, bank D, right? So all these banks will create the charge. Now, how the priority is decided? Let's talk about it. So the priority rule is that first bank to register charge is the first to get paid. So what I'm talking about, very, very important aspect we're talking about. So when charges are created in favor of multiple banks, priority is given based on the charge creation. So I told you priority is given based on the charge creation. So use form CSG1 to register and CSG4 to close. So for registration of the charge or modification of the charge, you require to fill the form CSG1. And if you want to close the charge, if you want to close the charge, so then you can use the CSG4. Now, if we talk about the company's type, so remember, India's companies are regulated under the Companies Act and they must be registered as per the Companies Act 1956. One more thing is that, Section 12 of the Companies Act prescribes that a company is formed through the MOA and AOA. So company type, normal company if it is, then they need MOA and AOA. And a statutory corporation like SBI if it is, they are created by Parliament. So remember, in the MOA, it set out the company name, registered office, authorized capital, shareholder liability and the objective, right? And there are something called a statutory corporation. So for that there is a special act of parliament after which they are created, like SBI. SBI it is a statutory corporation, right? So what I'm telling you, that a company is formed through its MOA and AOA, and some company may be registered under the Companies Act or incorporated as a statutory corporation by a special act of parliament, right? Like for example, as I given you, State Bank of India, they are autonomous entity with defined power, duties, privilege stipulated by the statute, right? That is the point. So such corporation enjoy financial independence but remain accountable to the law that established them. Now let's talk about the trust. So friends, can trustee take loans? What if they die? 90% don't know about this trust secret, and I'm here to uncover all these secrets. Let's have a look. First of all, you must know the basics that trustee is the legal owner. See, trust is a legal arrangement where a trustee hold property for the benefit of a beneficiary or a specific purpose. So trustee. Trust is called arrangement. Trustee hold the property for the benefit of a beneficiary, ensuring that the beneficiary receive the real benefit. So check before death is still valid. Now let's talk about the key difference between the private trust and the public trust. One more point is that trust account must be operated by individual authorized through a formal resolution. So if we talk about the difference between private and public trust, you must know that private trusts are for family or known beneficiary, right? So private trusts have identifiable beneficiary, while public trust, they are for society. You have to register with the charity commissioner. So private trusts have identifiable beneficiary, while public trusts serve the general public. So private trusts fall under the Indian Trust Act, where public trusts fall under respective state public trust act. That's the difference. Remember, private trusts are for family, known beneficiary. Public trusts are for society, right? And one more point is that if we talk about the operational rule, so I told you what is the trust deed. Trust deed act like a rule book. So trust deed is the foundational documents, and the registration of the public trust is overseen by the charity commissioner. Yes. So question may be asked, who oversee, who monitor whether the trust has been registered or not? The answer is charity commissioner. So trust deed provision dictate account operation. If it is silent, all trustee must manage the account jointly, right? So this is a very important point. Now let's talk about the operation rule. What is the operation rule? All trustee must jointly operate unless deed say otherwise. All trustee, they must jointly operate. Now second point is no power delegation, even if all agree. What I mean to say, that payments are regulated based on the authority specified in the trust deed, including any stop payment, right? So that is the point. One more important aspect I'm talking about. Okay, let's talk about it. Yes, so I'm talking about this point, that trustee can't delegate. Club need 3 documents. POA stop at death. So let's look at this secret you are not told. First of all, trust must knowns. What are the point? No delegation even if all agree. Trust cannot delegate their authority to any other, even after the mutual consent. First point. Second point, loan is allowed only if the trust deed permit. If it is written in the trust deed, then only loan can be given. So trust deed is the foundational document, right? And registration of the public trust is overseen by the charity commissioner. Third point I told you, if the trustee died, property go to the successor, right? So means if the trustee died, right, then the payment goes to the property go to the successor. What is the rule regarding the club and society? Have a look. So club and society need registration certificate plus bylaw to open the account. And one more point is that check. Yes, suppose agent issue a check and it is presented after the agent death. So payment can be made as long as the principal is alive and the check is dated before the agent death. So check signed before the death is still valid. Now one more point is the managing committee. So managing committee control the operation. So suppose there is a small business unit. So typically up to 2 to 3 lakh. So in that case, composite loan may be provided to finance both current and fixed asset. Now basically, working capital facility like, overdraft. So we're talking about it. One more point I want to tell you, that power of attorney truth. What is the truth regarding the POA? POA, power of attorney. Auto cancel. Power of attorney is auto cancelled if principal dies or if principal goes bankrupt. Remember it. For every power of attorney there is a principal, and suppose the principal dies or principal goes bankrupt, what happened to the power of attorney? It automatically get cancelled. Remember, power of attorney must be stamped, must be notarized. State rule apply there. And if power of attorney is signed after revocation, so it is called bounce, the check become bounced, right? That is the point. Now let's talk about in detail about it. OD versus term loan, fund versus non-fund. Let's talk about it. So let's talk about the working capital loan. right? What is the working capital loan? So the loan which is given for day-to-day operation purpose, right? So working capital loan for daily operation, like overdraft, cash credit, bill discounting. So these are the three categories of the working capital finance which are given for day-to-day operation. Remember, they are given exclusively for purchasing the current asset. What is the meaning of current asset? So current assets are those assets, right? Basically, which can be converted into cash immediately or within 1 year. Those are called current asset. Can you give me some example of current asset? Like inventory is current asset, raw material is a current asset, which can be encashed just within 12 months. They are called current asset. So what I'm talking about, working capital finance for daily operation include OD, it include cash credit, it include bill discounting, but remember they are sanctioned exclusively for purchasing current assets. So we are talking in the context of trust. I told you, if it is mentioned in the trust deed, yes, they are allowed to take the loan, right? Remember it. Now what about the term loan? Yes, term loan are also allowed for big purchases like machinery, vehicle, property, but term loan are only given for fixed asset only, except tiny business. Now it very well that fund based facility. So what is the fund based facility? So so basically there are some credit facility where fund are involved. So here fund are disbursed by the bank, and what it includes? It includes overdraft, it includes cash credit, it includes term loan, housing loan, vehicle loan. So these things are under the fund based credit. What about the non fund based credit? So some kinds of credit are there where funds are not involved, like letter of credit, like bank guarantee, right? So these are called non fund based credit. I think you know it very well. Now, example of a non-fund based credit include bank guarantee, letter of credit, deferred payment guarantee, and bill co-acceptance term. So one more point is that in the non-fund based arrangement, bank fund are only released in certain circumstance, not at the point of good receipt. Suppose non-fund based arrangement is there, like LC. I receive the good. Shall I pay immediately? No. Right. So basically bank fund are released only in certain circumstance. And one more point is that finance provided to support business activity within India is called the inland credit. So basically bank pay only if the default happen. This is a very, very important aspect. Now let's look at the next point. Very, very important aspect. Using term loan for daily expense or working capital for machinery, it is a big mistake. Why? Because working capital loan, the purpose is the daily operation, like inventory, like salary, like bills. So that is the main motive of the working capital loan. Suppose the borrower is involved in export or import financing, even in Indian rupees, such as packing credit, they are called forex credit. What is the meaning of forex credit? Forex credit means suppose a borrower is there, he is involved in export or import financing, even in Indian rupees. So that is called forex credit. Fund based facility involve direct disbursement of money by the bank from the outset. Non-fund based facility entails the bank providing a payment guarantee of assurance. So in the case of fund based facility, direct fund is exchanged, direct fund disbursement happen. In the case of non-fund based facility, payment guarantee is given, payment assurance is given, actual fund are not involved, right? One more point is that working capital loan, you know it very well, they are the short term instrument which are designed to cover a company daily operation expense. And how to calculate the working capital? The formula is very simple. You need to add inventory, you need to add the account receivable, and you need to subtract the account payable. What is the meaning of account receivable? It is very simple. See, you have a business, you have given something on credit, you have not received the payment yet. Those are called account receivable, which means some money which are yet to be received. And what is the account payable? Suppose you have taken some items on credit and you have not paid yet. That is called account payable. So while calculating the working capital, we add account receivable because that money we will receive. That is our working capital, and we have to subtract the account payable because that money we have to give. Right? We have taken some goods and services on credit and we have not paid yet. That is called account payable. I hope the concept is clear. And it is short term, which means it must be repaid quickly. So that is all about working capital loan. Now let's switch gear and talk about the term loan. So term loan purpose is to buy the big asset like machinery, like property, like vehicle, and repayment time period, it very well. It is 1 to 10 year in EMI. Yes, EMI repayment is there, and collateral are usually required. Now let's talk about the key difference. So basically, working capital loan are like oxygen for daily survival, and term loan are like bones for long term growth. If you mix them up, cash flow disaster can happen. Right. So I told you now, working capital is very crucial for smooth functioning and growth of any business. And if it is huge, see, working capital should not be huge. If it is huge, it can lead to operational bottleneck, while an excess increases the cost. Right. So if it is, suppose working capital is very little, suppose we don't have the money to for our day-to-day operation, what will happen? Tell me, what will happen if we don't have the money for day-to-day operation? If the working capital is too little, it will cause operational bottleneck, and if it is too excess, it will increase the cost. That's the point. Now friends, one more point I'm talking about, both fixed capital and liquid capital, they are very much essential for any industry, for any business. Fixed capital needed for long-term asset, liquid capital needed for running operation. Now the question is, where fixed capital is invested. So fixed capital is invested in acquiring long-term asset like land, building, plant, machinery. And this fixed asset cannot generate income independently. They require sufficient working capital to support the production activity. Yes, very, very important aspect we are talking about. You know it very well. Why do business fail even with great machine? The secret lie in the working capital cycle. So fixed capital are given for machine and building, which means long term, and working capital are given for daily cash flow, which includes salary, which includes raw material. So friends, how the money cycle work? Let's have a look. So in the case of working capital fund, you can purchase, you can store raw material, you can make payment of salary, you can pay for utility expense, and you can pay the gap between the goods supply and the payment receipt. So you can see the working capital cycle. First of all, you buy the raw material, then you make product, then you sell the goods, then you wait for payment, and finally you repeat the cycle. Buying, making product, selling goods, waiting for payment. This is how money cycle work. And you know it very well. If the cycle is faster, it is better for business. So this is a continuous type of cycle, right? Raw material convert to WIP, WIP converts to finished goods followed by receivable, then cash, and back to raw material. Now friends, let's talk about the trading business. So for trading business, that the operating cycle spans from purchasing good to their sale and the realization of proceed. In manufacturing, the cycle covers the purchase of raw material, production, sales of finished goods, and the collection of payment. So basically, to the context of working capital cycle, it works both for trading business as well as the manufacturing. One more point is that consumer goods industry experience quicker working capital cycle, while capital good industry have obviously see two kinds of industries are there. One is the consumer goods industry, other is the capital goods industry. So capital goods industry, they take longer time. So obviously they have a slower working capital cycle. And consumer good industry, consumers are buying more frequently. That's why we have a shorter working capital cycle. Perishable goods like food having short cycle, while commodity like tobacco, they have a longer cycle, right? Some seasonal industry like umbrella, woolen fabric manufacturer, they require fluctuating stock level, peaking in certain month and minimal otherwise. Right, these are the very important aspect. So friends, what happened during working capital cycle? During working capital cycle, your fund are tied up in cash, inventory, receivable. So all of these require financial support, right? So this is the very important part. Now friends, fixed capital, where it is invested? Fixed capital invested in I think this is the repetition. We have already discussed all this aspect. This is the repetition. Now friends, what is the meaning of shorter working capital cycle? Why do profitable business run out of cash? The answer lies in your working capital. Yes, because of the working capital, the profitable business run out of the cash. So the golden rule is that, if you have a shorter cycle, it means money rotation is faster. Faster money rotation, it means more profit. And if you have a longer working capital cycle, it means cash is stuck somewhere and it means simply travel ahead. Now friends, we talk about the current asset. What is the meaning of current asset? See, it is simply means, your liquid gold. How does it move? So first of all, you have cash. Those cash turns into inventory. Obviously you purchase the material and there is an inventory. Then you sell those inventory, then you have receivable, and then you again receive the cash, right? So that is called current asset, your liquid gold. So finished good must sell within the 1 year. That is called current asset. Means such kind of asset which can be quickly sold within 1 year, they are called current asset. Like your inventory, like your receivable, they can be converted into cash quickly. That's why they are called current asset, right? Now what are current liability? So current liability are like short term debt, right? Why I'm talking about this? Because if you want to efficiently manage the working capital, it require monitoring both current asset and current liability. So current asset, you have understood, you were having cash. From cash you bought inventory. From inventory you got the receivable, and from receivable you got the cash again, right? Now let's talk about the current liability. So current liability are short term debt. What happened here? Supplier credit, right? Supplier credit means whoever is the supplier, he gives the amount in credit. Then bank overdraft, So these are the types of current liability: supplier credit, bank overdraft, upcoming loan EMI, right? So these are different kinds of liability we have. So it includes short-term obligations which are repayable within 1 year, right? They form, so remember, they means current asset and current liability. They form the primary source of working capital finance, right? This current liability, they form the primary source of the working capital finance. From where we are getting this finance? Obviously from current liability, right? So this is a very important thing. Now one more thing is that let's look at some danger sign. Danger sign is okay. What are the danger sign? Let's have a look. But before that, while we are assessing the working capital need, bank borrowing are excluded from the total current liability, right? So what happened, whatever bank has borrowed, they are excluded from the total current liability. With the remaining terms, we call it CLOBB. What is CLOBB? Current liability other than the bank borrowing, right? So current liability are those liability which are the short terms which we have to pay within 1 year, right? So they are primarily why we take such liability, so as to finance working capital and to acquire the current asset. They form the primary source of working capital finance. Remember, current liability form the primary source of working capital finance. And while we assess the working capital need, whatever borrowing we have done from bank, we don't include that and we exclude that. And after excluding, whatever term which is left is called CLOBB, which is the current liability other than the bank borrowing. So I told you what are the things included under the current liability, like bank borrowing for working capital, other short-term borrowing, sundry creditor, term loan installment, other payable and provision, right? These are the things which are included. So under the current liability. Now one more thing is that current asset are also called convertible, liquid or floating asset. They continually change form and ultimately convert to cash. And finished goods classified as current asset, they are intended for sale and conversion to cash within 1 year. So what are the components of current asset? Like cash inventory, book debt. What is the book debt? That's called account receivable. What is account receivable? Suppose you are providing some kind of goods and services. You provide some kinds of goods and services to some people on credit. They have not paid you. They will pay you on the due date. So such kind of payment are called account receivable, which are due, which you have not received yet. So this account receivable is also a kind of current asset. Obviously, it's a kind of asset for you, right? Then they also call book debt. Either you call him book debt or account receivable. So account receivable, cash, inventory, other loan and advance, these are the components of the current asset. Now what are the things under inventory? Raw material, work in progress, finished goods, store, packing material. These things are under inventory. Now one more important point is that let's try to understand. See, your car is a fixed asset or current asset. Tell me. Answer: it depends. Let's decode working capital in just few minutes. First of all, asset secret. If you hold excess asset unnecessarily, what will happen? It will increase business cost, because you have to pay additional interest, you have some borrowing expense. So remember, for individual like you and me, house or flat is a fixed asset. For a builder selling house, the same property is considered the current asset. You can see the same flat is fixed asset for me, while for builder it is a current asset. Sorry, it is a current asset. Yes. Similarly, suppose an individual who is running auto services for auto shop, right? For auto shop, the car is a fixed asset because it is an income tool, because it generates income. However, for the dealer, for auto dealer, the vehicle are current asset because it is a kind of inventory, right? So same material is like acting like a fixed asset for some person, while current asset for another person. You can see it. Now let's look at the mathematics of the working capital. So friends, that through the context of working capital, there is something called working capital gap, or we call it WCG. What is the meaning of WCG? See, you subtract the current liability, excluding bank borrowing, which is called non-bank liability. You subtract the non-bank liability from the current asset, you get working capital gap. How to calculate WCG? Quite simple. First of all, you write the current asset, then you write the current liability, and from the current liability, you subtract the bank borrowing, that is called CLOBB. So if you subtract CLOBB from current asset, you will get WCG. One more thing is that okay, so that is the mathematical part. Now what is the physical meaning of this working capital gap? Try to understand. See, part of the current asset which is financed by non-bank current liability, they are called working capital gap. Sorry, some part of the current asset, from where you are financing the current asset, some part of the current asset you are financing from the non-bank current liability, right? And the remainder requiring funding is called working capital gap. So we have to finance the current asset. Whatever asset we are acquiring, we have to finance that. From where we will get the finance? So one source of financing is the non-bank current liability. The remaining source of financing is the working capital gap. I hope that makes sense to you. That's why we subtract non-bank liability from the current asset to get the working capital gap. Entrepreneur typically finance a portion of the working capital through long-term fund, and that is called the margin. Yes, whenever you go to take loan, what bank will ask for? Bank will ask for a margin. What is margin? Margin is the amount of fund, amount of the working capital that you are getting through long-term fund or capital. So how to calculate the WCG? It is very simple. You subtract CA, that is the current asset, and from CA you subtract the CLOBB. Now the second terminology is the NWC. What is NWC? It is called net working capital. Means what you fund long term. So it is technically defined as the long term source minus long term use, representing the sustainable capital, right? So it is technically defined as long term source minus long term use, basically representing the sustainable capital, or we can call it current asset minus all current liability including bank borrowing. So bank borrowing are not excluded here, bank borrowing are included here. So current asset minus current liability is called NWC. Means what you fund long term, right? So basically I told you now. So what does NWC reflect? It reflects the margin, it reflects the portion of the current asset financed by the borrower long term fund. So current asset is an asset, liability is further categorized into long term liability and short term liability. So asset is being financed by liability, it very well. So if the borrower is financing as current asset using long term liability, so that portion is called NWC or net working capital, because it is also called margin, because whenever you go to take the loan, bank will ask for your margin, bank will ask that you should contribute also, and that particular contribution which is taken from the long term fund is called NWC or net working capital. So remember, I hope it is clear now what is WCG and what is net working capital. So WCG reflect what I told you, that WCG reflect the current asset minus we are funding the current asset. So some funding is being done by the non-current liability, and except those funding, whatever is remainder is called WCG. And second point, we talk about the NWC, which is the net working capital, means part of the what is current ratio? It is very simple. It measures the liquidity. It is simply the ratio of current asset to current liability. That's why it's called measuring the liquidity. Means it simply means that if your current liability is 1 unit, how much is your current asset? That is what it reflects, right? So suppose if the current asset is large, it means liquidity is there, right? So current ratio assess the business liquidity. A ratio below 1 is generally viewed as unfavorable, right? Means per unit like a liability, how much asset you have, right? That is what current ratio. And if the current ratio is less than 1, it is a danger zone. And suppose current ratio is greater than 1, what does it mean? That it means we have an excess inventory. Obviously, we have an excess inventory. That is what it means. We have a larger current asset. That is what it means. So excess inventory means interest cost will be higher. And so what is the golden rule is that you should just keep enough stock. So you have to just maintain the current ratio somewhere near 1, greater than 1, not less than 1. Right? If it is 2 more than 1, suppose it is 1.81, suppose it is 2, it means that you are holding more inventory. Right? So large industrial projects often demand significant investment in both fixed and working capital, while trading firms may not require heavy fixed asset, but then they tend to maintain large inventory, and inventory is a kind of current asset. So basically it varies from industry to industry. Some industry requiring large amount of fixed and working capital, while some industry like trading firm, they require inventory only. Service sector business might need minimum working capital but sustainable investment in fixed asset. Some loan extended for acquiring current asset, they are called working capital loan, and those loans which are acquired for fixed asset, they are called term loan. Yeah, I think you know it very well. Term loan and working capital loan. So current ratio formula, you know it very well. Current asset divided by current liability. If it is below 1, it is a danger zone. The second key terms is DER, that is called debt equity ratio. So basically in the numerator we write the total debt, in the denominator we write the owner investment. We divide the debt by equity, this will give us DER. And good is below 2:1. So suppose DER shows how much of the business is financed by the debt in comparison to equity. See, there are two ways of financing the business. Either you take the debt or you take the equity. So how much debt you are taking and how much equity you are taking, that comparison is being made by. So when DER is good, DER is good if it is below 2:1, and DER is at risk if it is above 3:1. Right? Remember it. Very, very important aspect. So DER is also called external internal equity ratio. It reflects the balance between external liability and shareholder equity. So if it is excessive debt relative to capital can disadvantage unit, making repayment of loan installment and interest difficult if profit falls short. Right. So that is the point. An optimal DER is generally considered to be 1:1. Capital intensive business may have a higher ratio, signifying ongoing asset maintenance financed via borrowing, which can boost the return via greater production capacity. So working capital need for manufacturing is high fixed plus working capital. If it is trading, low fixed but high inventory. If it is services, low inventory but high fixed asset. So depending on the types of industry, if it is a manufacturing activity, if it undergo manufacturing activity, its working capital needs high fixed capital is more, and working capital is also high. Trading, low fixed but high inventory. Services, low inventory but high fixed. Right. So we are talking about the DER. So I told you 1:1 is the gold standard. Above 2.1 it is a danger zone. Capital heavy business, it can go higher if the asset boosts future income. Let's talk about DSCR, which is the debt service coverage ratio. What is the formula? In the numerator we write cash profit plus interest. In the denominator we write the loan payment. So basically it compare cash available for debt servicing to the cash obligation. What is the cash obligation? Cash obligation means loan. And what is the cash available? Cash available means cash profit plus interest. So basically it compare cash profit plus interest divided by loan payment. It shows the company ability to meet its debt payment, whether the company is able to meet its debt payment or not. That is what DSCR shows you. So basically if we talk about the lengthier formula of it, right, so we can write it like net profit after tax plus depreciation plus interest, right, on term loan divided by net profit after tax plus depreciation plus interest on term loan. So basically this is divided by the interest on term loan plus principal repayment, right. So NPT plus depreciation plus interest on term loan divided by interest on term loan plus principal repayment. That is called DSCR. Because depreciation is a kind of non-cash expense. That's why it is added to the operating profit to determine the actual fund generated. So basically we are trying to generate the cash inflow, and that particular cash inflow is the cash profit, and we are adding the interest on the term loan, and we are dividing by the loan payment. How? So basically loan payment, you are paying the interest component, you are paying the principal component. That's why in the denominator you will see interest and principal. I hope it is clear, right? So basically what it says that whether our cash inflow is sufficient to service our debt or not, right? So can you tell me what will be the ideal ratio? So the safer is 1.5:2. So when I say 1.5, it means it simply means for 1 unit debt with principal plus interest, we are earning, our cash is generating 1.5. So yes, we are profitable. So and if it is 2, it means for 1 unit debt that we have taken, our cash inflow is 2 times. So yes, it is still profitable, right? So sometimes confusion arises why we add the depreciation, because the depreciation is a kind of non-cash expense, and while we calculate the total cash inflow, we need to add it. And remember, on the DSCR, numerical questions are asked every year, right? So this is the point. So if high DSCR, bank will love you. If you have higher DSCR, so bank will love it, right? Ideal DSCR between 1.5:2. I think you know it. So one more point is that while evaluating a loan proposal, it is crucial to analyze both the overall and year-wise minimum DSCR to assess the debt service coverage capacity. So basically what I am talking about, DSCR acts like a profit test. You must show the yearly repayment capacity, and red flag if anything is below 1, it is obviously rejection risk is there. Now there is something called gestation period. So the factory rule says that no income during setup, and a smart move says that you should negotiate repayment holiday. See what happened, repayment holiday should account for the gestation period and additional time needed for the realizing the sale. So business owner, they are expected to invest a portion of the project cost themselves. This is called promoter contribution. You know it very well. So the golden rule is that initially the promoter contribution is 20 to 50%. Margin represent a part of the promoter contribution, right? In sometimes margin and promoter contribution are the same, but they usually differ. Promoter contribution refers to the total project cost, while margin is calculated for each asset financed by the loan. So promoter is a big picture. You are looking at the whole picture, right? It relates to the total project cost, while margin is about the individual asset. So one more point is that what is about the interest accrued. So whatever interest accruing during the loan repayment holiday, that has to be added to the loan upon the completion of the holiday with a fresh repayment schedule. This is called interest capitalization. So what is the meaning of interest capitalization? It simply means, unpaid interest get added to the loan. Now there is something called, IOI, interest only installment period. So, it says that you pay only interest initially, like in the case of home loan. Many home loan offer such as holiday at the start, Then we have the IPI. What is IPI? IPI means, it's called interest payment installment, interest principal installment. So borrower pay fixed monthly principal installment plus interest as it accrue. And then we have EPI or EMI. So borrower pay fixed periodic installment covering actual interest first, other due second, and remaining amount toward principal. Then we have PMI, which is called, post maturity installment. So if the loan remain unpaid after maturity, it enter PMI stage, governed by specific rule and governed by the specific rate. What is bullet repayment? So in the case of bullet repayment, interest is paid monthly with the entire principal repaid in lump sum at maturity. So interest is paid monthly and the entire, principal get repaid in lump sum at maturity. That is called bullet repayment. Means principal repayment happen at the maturity. Now one more kind of repayment is called, balloon repayment. So don't confuse these two. What is balloon repayment? Principal and accumulated interest for the entire term are paid together on the maturity date. So friends, try to differentiate the bullet and balloon repayment. In terms of bullet repayment, I told you that interest is paid monthly with the entire principal repaid in lump sum at maturity. While in balloon repayment, I told you, you pay nothing until final day. Right. Now friends, let's talk about SURF. What is SURF? So basically a step up repayment facility. So basically what happened, this is a kind of a smart option. Start small, increase with salary hike. That is called SURF, a step up, right? Then we have the flip. What is the meaning of flip? That is called flexible roll installment plan. So what happened here, start big, reduce as you age. Then we have the tranche based EMI. So which means, pay only on the use fund. It is great for under construction home. Right, for under construction property loan. So suppose you take loan on the under construction property. So interest is paid only on the drawn amount until full disbursement. So pay only on the used fund. So whatever fund you have used, whatever drawn amount, so pay interest only on that until the full disbursement. After which the regular EMI begins. So this is how it works. Now we have the accelerated payment. What is the accelerated repayment? So raise EMI yearly to clean loan faster. Balloon repayment, I told you, pay nothing until the final day. That is called balloon repayment. So I hope these things are clear. Now friends, let's talk about the telescopic repayment option. It allows extended repayment tenure up to 30 years, enabling eligibility for higher loan amount. Now let's talk about the bill finance. So bill finance is a short-term self-liquidating form of credit. Who are the three parties involved in the bill of exchange? So the first one is the drawer, who is the seller. Second is the drawee, who is the buyer. And third is the bank, who is the payee. Right. So three parties I told you: drawer, drawee, and bank. Drawer is the seller, drawee is the buyer, bank is the payee. Right. Now bill of exchange are categorized as two parts: demand bill and usance bill. Demand bill, they are payable immediately like a check, and usance bill, they are payable after a set period. Then we talk about the smart financing option. So clean bill. What is the meaning of clean bill? So you know it very well. And one more point I want to tell you that advance like supply bill, they fall under the bill purchase for administrative convenience, right? Demand bill is payable on demand or at site or upon presentation without a fixed payment date. So demand bill do not attract any kind of stamp duty. What is the meaning of clean bill? So that is called CDB, clean demand bill. So clean demand bill is an unsecured check or bill of exchange payable on demand purchased by the branch. That is unsecured high risk. Then we have the secured demand bill, or we call it SDB. This is accompanied by document of title to good and is payable on demand at an outstation location. So clean demand bill, unsecured check purchased by the branch. Secured demand bill accompanied by documents of title to good and is payable on demand and also purchased by the branch. So bill financing form part of the overall working capital financing facility. So demand bill attract no stamp duty. It is a part of the working capital finance, and telescopic option, it is up to 30-year repayment. Remember it. Now let's talk about the railway receipt. So railway receipt, in the case of railway receipt, you know it very well that your shipping document could either make or break your loan approval. So if we talk about the railway receipt, it must show the goods consigned to the bank or the consignment order and endorsed to the bank to prevent delivery against indemnity. So you must name the bank as consignee. That is what I mean to say in the terms of railway receipt. Then we have the lorry receipt. So in the case of lorry receipt, only IBA approved format is accepted. IBA Indian Banking Association, so they have a format and only IBA approved format is accepted. If we talk about the airway bill, you must remember that it is non-negotiable. Airway bill is non-negotiable, so it must address the bank directly. Then we have, let's talk about the instant rejection. So suppose receipt for shipment bill of lading, it will be instantly rejected. They are not acceptable. So bill of lading marked receipt for shipment, they are not acceptable. Accommodation bill or check, not acceptable. Remember. So third is the unapproved transport company receipt, not acceptable. So you can see that bill of lading marked receipt for shipment not acceptable for discounting. Post parcel may be addressed to the collecting branch or bank. Airway bill are non-negotiable. Good must be consigned to the collecting bank branch. Accommodation check bill are prohibited from purchase or discount. Lorry receipt from unapproved transport operator, it should not be accepted. So which things are not accepted, you must know. Receipt for shipment, bill of lading not accepted. Accommodation bill or check not accepted. Unapproved transport company receipt not accepted. And what are the danger zone? Perishable goods. Obviously risk automatic sale in 48 hours. For perishable good, transport operator, they may sell the good after 48 hours if unclaimed, notifying and accounting to the bank letter. And only accept, carrier risk lorry receipt. You must have full set of clean bill of lading. These are the points which you must keep in mind. Then one more point is, check or bill return. Let's talk about it. Suppose a check got bounced. You need quick cash. So these banking rule can save or cost you 1,000. So suppose immediate cash rule is that under 15,000 rupees, you get instant credit. So immediate credit up to 15,000 for outstation check should be granted automatically. Above 15,000, what happen? So it is, if it is immediate check or local check up to 15,000, it can be up to 15,000. It can be granted automatically. But above 15,000 check, you must wait for clearance. So whether local or outstation check above 15,000, you must wait for clearance. If it is bounced once, what happen? Never accepted again. If it is once bounced, it will never be accepted. That is the point. Advance may be extended to the buyer of such commodity through purchase of bill backed by the document subtitle like railway receipt. One more point is the LDSB. LSDB. That is a loan secured demand bill. So Usance bill, this is the smart bill financing option. What is Usance bill? That means you pay later, not immediately. What is LSDB loan? So you must repay within 21 days. So those commodity which are listed under the SCC directive, right? So some commodities they are listed under the SCC directive. So for them LSDB apply. So what it say that advance may be extended to the buyer of such commodity through purchase of bill backed by document of title like railway receipt and bill of lading. Loan or LSDB advance cannot be granted against the lorry receipt or for commodity under SCC directive. And one more point is that this LSDB must be repaid upon arrival of the goods or within 21 days from the discount date, whichever is earlier. So whether discount date is earlier or goods arrive earlier or 21 days from the discount date, whichever come earlier, LSDB must be repaid. Means it is a kind of loan which you have taken, right? It must be repaid within 21 days. A Usance bill is payable after a you know it very well that Usance bill has a due date. It will be payable after that. So what we learned is that dividend or interest warrant under rupees 15,000 instant cash, and 21-day rule start from the discount date, not the delivery date. Remember it. Now let's talk more about the Usance bill. So I told you, you must use a stamp hundi paper except 90-day banking transaction. So this is what I am telling you, that Usance bill attract stamp duty and must be drawn on the hundi paper with adequate stamp value, right? Two types of Usance bill are there, DA and DP. DA means document against acceptance, right, which is a riskier because documents on acceptance, and DP documents on payment, which is a safer, right? So in DA documents are handed to the drawee upon acceptance of the bill. So basically drawee is one who accepts the bill. So I told you drawer is the seller, drawee is the buyer. So the bill will be handed to the drawee upon acceptance, and in the case of DP, documents are delivered only after the payment of the bill. That is quite safer from the seller point of view. Now if we talk about the government perks, so in case of DA, bill accepted, document handed. DP, right? DP, once payment is made, then documents are given. So DA is unsecured, DP is secured. Now government perks. If we talk about the government perks, stamp duty is free for 90-day bill. So such kind of bill which are payable within 90 days, Government of India exempt stamp duty on such kind of bill. Promissory note does not qualify under it, right? So this exemption does not apply to Usance promissory note. So this exemption that we are talking about, basically the Government of India is stamp duty free for 90-day bill, does not apply to the promissory note. And what does the RBI rule say? RBI rule say that big loan larger than 5 crore need 25% bill finance. So according to the RBI norm, borrower with fund-based working capital limit of 5 crore or more, right, they must adhere to the financing limit on inland credit. So what it says that they need big loan greater than 5 crore, they need 25% bill finance. That you can see with at least 25% finance through the bill of exchange. So what we learned is that clean bill, no collateral, documentary bill secured by good, right? So they can be drawn locally or they can be drawn attestation. DA, unsecured if buyer does not pay, and wrong stamp value, this will be invalid, the bill will be invalid. Now let's talk about the supply bill. So government contract, and this means delayed payment, right? So basically what is supply bill? This is the kind of bill for government or supply contract, means such kind of transaction involving the government and public sector entity. What are the supporting documents? Supporting documents includes delivery receipt or departmental acknowledgement. So e-way bill needed. If the good value exceeds 50,000, in that case electronic e-way bill is required. You can see clearly written that e-way bill is required for transport of consignment good valued over 50,000. Now, if we talk about the bill financing type, there are 3 types of bill financing. The first is called bill discounting, which means for future date usance bill. Then we have the bill purchasing for immediate demand bill, and then we have the negotiation, which is done against the letter of credit. So there are three ways of bill financing. First of all, discounting for future usance bill, purchasing for immediate demand bill, negotiation against letter of credit. 2 systems we have talked about, right? What are the 2 systems? Drawer bill and draw bill. Drawer bill, what is drawer bill? So bank fund seller, and draw bill, what happen? Buyer's bank guarantee payment. 2 bill system I told you. Under the drawer bill system, bill are discounted or purchased for the seller and bank assessing the drawer credit worthiness. And in the case of draw bill system, the buyer bank accept the seller bill on the buyer behalf and seller bank extend finance on the strength of the acceptance. So you should use draw bill if the buyer has a better credit, and e-way will avoid transport hassle. Remember, these are the important points. Now now let's talk about some kind of arrangement that we have. So what is the meaning of sole banking? In the case of sole banking, one bank handles everything. Simple it is, but riskier for lender. What is consortium? In the case of consortium, multiple banks share big loan. It is common rule for all. Then then we have MBA. What is MBA? Multiple banking funding. What happened here? Different bank can fund the same business. Must declare all the existing loan. No splitting division artificially. So in the case of MBA, basically borrower may obtain fund based or non-fund based facility from multiple banks without formal consortium arrangement. That is called MBA. You must declare all the existing loan. So when the borrower has credit from multiple banks, declaration about existing facility must be obtained, right? So that is the point. So then we have syndication. What is the meaning of loan syndication? It means lead bank manage the group lender. So there is a lead bank. Here also many bank combine to give loan, but here the role of the lead bank who manage everything, right? So it is based for massive project, more than 100 crore. So you should watch out for hidden fee in the multi-bank deal, right? This is a very important thing. So we have talked about the consortium, multi-bank arrangement, right? We have talked about consortium financing and sole banking, consortium, multiple banking, syndicate banking. These are the very, very important aspect. Now friends, one more important point I'm talking about is that syndicate of if we talk about how do mega corporation get $100 million loan. So the secret lie in syndication. What is syndication? So the key difference between syndication, consortium and lead bank is that in the case of syndication, it is global and multi-currency deal, while the consortium is local. It is quite local and single currency funding. And lead bank may lend $0 but earn big fee. So lead bank, they may earn nothing, but they earn big fee. Now how syndication work? Let's have a look. What happened? One bank become matchmaker. They prepare the deal document. They recruit other lender. They take 1 to 2% fee, right? So the one bank who is basically called lead bank, they become the matchmaker. They prepare the deal document. They recruit other lender. They take 1 to 2% fee, right? So let's talk about the power dynamics. So I told you lead bank control everything. All banks share risk, and you must review the information memo before joining. These are the important part. Then if we talk in the context of consortium, consortium, what happened? If the loan is 150 crore plus, so it required JLA. What is JLA? Joint lending arrangement. That is called JLA. So you can see JLA. What is JLA? Joint lending arrangement is required if the loan amount exceed 150 crore plus, as you can see. So here a single borrower with aggregate credit limit of 150 crore plus, they require JLA. So in this case, multiple public sector bank come together, and this is the biggest lender lead. Yes. Then we have, LSDBC, that is called loan system. That is loan system for delivery of bank credit. So what it says that 60% must be term loan. So it apply to borrower with fund-based working capital facility of 150 crore or above. For such borrower, at least 60% of the credit must be in form of loan. Right, this is a very important aspect. And there are some exemption which is given to the seasonal business. Right, seasonal business, cyclical business, volatile activity. So those kinds of firms having 150 crore plus working capital, so their 60% of the total fund must be in the form of I told you they must term loan, right? 60% must be term loan. So if it is a single entity, remember bank see all division as one. If it is under 150 crore, then they can still opt for JLA voluntarily, right? These are the important points. Now let's talk about the credit appraisal. So what we have just discussed, DSCR, I told you, debt service coverage ratio, it must be greater than 1.5, right? Then we discuss, DER, debt equity ratio, ideal is 1:1, right? Then 5 lakh plus loan, mandatory cash flow. Now there are some methods. Then the question based on these methods are asked every year. So how to do the working capital assessment? So we have the MPBF method, we have the turnover method, we have the cash budget method. In the MPBF and turnover method, sales accepted for eligibility is based on submitted estimate and projected sale. Turnover method is all about, NIC committee method or projected sale method. For established business, future sale projection depends on the past performance, capability and market condition. Right. The turnover method uses accepted sale as the basis for calculating the permissible bank finance, and the MPBF system calculates permissible finance by assessing the current asset and current liability related to the accepted sale. What is the meaning of accepted sale? Accepted sale is based on submitted estimated and projected sale alongside actual balance sheet of the past 2 years. Right. So turnover calculate accepted sale as the accepted sale as the basic for calculating the permissible bank finance. So turnover method, it is recommended by the PR Nayak committee and was reviewed by the VAS committee. What happened under the turnover method? It says that working capital limit are set at 20% of the bank accepted provision gross sale, maintaining a minimum margin of 5%. So 5% contribution should be done by the whom? It should be done by the borrower, right? That is the turnover method. Turnover method is easy. It says that get 20% of your annual sale as loan. For MSME 5 crore, for trader 2 crore, and minimum 5% margin from your pocket. So if the available net working capital exceeds 5% minimum margin, it is considered in determining the bank finance. So it applies to MSME, it applies to non-MSME, MSME up to 5 crore, non-MSME up to 2 crore, trader, merchant, exporter, other without up to 2 crore. These are the point. So eligible fund-based credit limit under this method are computed at whatever annual sale you have, calculate 20% of that, and you can get 20% of the annual sale as loan, right? That is called working capital limit, and you have to give 5% as the margin, 5% of the total sale from your pocket. That is the margin. Okay. Then so it is where it is applicable. I told you for MSME up to 5 crore, non-MSME up to 2 crore. And one more thing is the MPBF method. So Tandon committee, 3 methods are there: first method, second method, third method. So the formula is Tandon committee method is formula is asset minus 25% margin. So in the Tandon committee second method, it says that borrower must provide a margin of 25% on the total current asset, and MPBF is total current asset less the margin, right? So that is what MPBF is. So asset minus 25% margin. So that is Tandon second committee, Tandon committee second method, and Tandon committee first method. What does it say? So in that case, 25% of the WCG, not current asset, WCG, working capital gap, right? So first of all, you have to calculate the WCG. How to calculate the WCG? Current asset minus current liability other than bank borrowing. Apply this formula to get WCG. Calculate 25% of that. So that's 25%. You have to subtract, and that is your margin. That is your margin, right? So margin you have to subtract from the total the asset. Then only you get the MPV, maximum permissible bank finance, that bank will finance. So total current asset, and in the case of second method, you can see total current asset minus this margin. Margin is almost 25% of the current asset. And it very well that Tandon second method require a minimum current ratio of 1.33 with a specific relaxation allowed as needed, right? So that is what I am talking about. I think this is a repetition. Just now we have talked about all these aspects. Yes. So now who wins? So for manufacturer, use Tandon method, right? For manufacturer, use Tandon method. For trader, prefer turnover method. So if existing net working capital is larger than 5%, get better terms. So remember, MPVF method applied to fund-based working capital limit for MSME above 5 crore, non-MSME above 2 crore, within 2 crore and 5 crore, turnover method is there. Above 2 crore and 5 crore, MPVF method is there. And for limit exceeding 25 crore, borrower may choose MPVF or cash budget method for assessment. And 10% tolerance is allowed on the assessed MPVF. I hope that makes sense to you. Now friends, that is what we have discussed just now. Now let's talk about the cash budget method, which is a kind of seasonal method. So basically it is based for tea, sugar, cyclical industry like software, construction, tea, sugar. So what it tracks, it tracks the monthly cash gap. It tracks monthly cash gap, right? And the key difference are that there are something called positive NWC, negative NWC. So if the positive NWC, it means asset is larger than liability. If it is a negative NWC, it means danger zone. And turnover method usually have 1.25 ratio is the best. That is the point. Now let's talk about the next point that we have. So the 5C that the bank check. What are the 5C? Credit history, repayment capacity, available capital, loan condition and collateral. Character, capacity, capital, condition, collateral. Character means credit history. Capacity means income versus EMI. Capital means your saving or investment. Condition means loan purpose. Collateral means security backup. So these are the 5 things that bank check before sanctioning a loan. So hidden risk type are default risk. You know it very well. Default risk means you are not able to pay the EMI. That is default risk. Downgrade risk. What is the meaning of downgrade risk? Suppose your credit score drop. That is downgrade risk. Then we have the concentration risk. So all egg you are putting all egg in one basket. That is called concentration risk, right? Institutional risk. When legal framework failure or issue with regulatory entity, that is called institutional risk. Who manage this risk? So there is a board of director who have the final responsibility. There is a risk committee who set the policy, CRM department who daily monitor it. So the pro tip is that you should keep debt to income less than 40% and you should diversify your income source. Remember, numerical based questions are being asked on the chapter of this MPVF and turnover. So make sure that you practice enough question before the examination. Now friends, there is the 4 decision layer. What are the 4 decision layer? The first is the board of director, right? So he set the risk limit. Second is the risk committee who balance profit versus safety. Then we have credit policy committee who make the loan rule. And finally we have the CRMD. Who is CRMD? CRMD is the police auditing every loan. How they judge you? They judge you based on the default risk. Will you pay back? Spread risk. Does your rate cover the risk? Portfolio risk. Are loan too similar? Remember, one bad sector will cause loan rejection for all in it. So your loan is stress tested against the economic crisis. So friends, let's end our discussion here for the module A. We will cover the remaining. If you think that it was really helpful, please write yes in the comment section so that I can bring module B quick revision also if it was really helpful for you. And if you want such kind of PDF, you can WhatsApp me on this particular number